Hello, and welcome to this special retirement income discussion from DoubleLine. My name is Dan Long, and I am a Retirement Solutions Relationship Manager here at DoubleLine. I am so happy to be joined today by my colleague, Phil Gioia.
Hey, Dan, thanks for having me.
Oh, thanks for coming, Phil.
Of course.
Phil is a product specialist here at DoubleLine. He is a CFA charter holder, and he's been working very closely with our portfolio managers for over 6 years now. Phil and I also had the opportunity to co-author an article earlier this year called What's the Big Idea in Retirement Income Asset Allocation? Essentially, it's an article that discusses fixed income's unique role and multi-purpose role in retirement income analysis using the framework BIGG. BIGG stands for Ballast, Income, Growth, and Gates. And those are the 4 criteria that you can use across all types of retirement income products, both guaranteed and non-guaranteed, to try and come up with a framework to make it easier to analyze a very disparate group of products. So Phil, we're going to start with ballast. Tell us a little bit about fixed income's role as a ballast in asset allocation today and today's capital markets.
Yeah, certainly. So, I think when we think about fixed income here at DoubleLine, right, we do want to serve as a ballast. And what that means for us is thinking about a retirement plan broadly, there's going to be a mix of investments, right? There's going to be some stocks, there's going to be some cash, there's going to be some bonds, maybe some other retirement products. But the traditional role of fixed income has served as that ballast to equities, right, or the riskier parts of the portfolio. So what we've seen historically is that bonds or fixed income have displayed much lower volatility than equities, right? So that's one way to reduce overall portfolio standard deviation, right, or volatility. So bonds can provide that smoother ride. And then also they have that lower correlation to equities, right? Because you want something that will zig when other parts of the portfolio are zagging. And what we've seen fixed income really, when we've seen it shine, is when you've seen very down equity markets, right? So if the S&P has been down 20%, on average, you've seen, many parts of high quality fixed income return 5, 6, even 10% if you look at US Treasuries. So when we think about ballast, right, we want to have lower volatility, which we've seen fixed income do through time. You want to have lower correlation to equities. And what that should do, again, is provide, zigging and zagging in different parts of the portfolio. You never want everything to be going one way. Well, I guess if everything's going up, you do want that, but we know, markets don't operate like that. So you want to have a ballast to, offset potentially some of the riskier investments in that fixed income or in the retirement portfolio.
I agree, right? Diversification of cash bond stocks is super important, and the diversification of retirement income is just as important between kind of your guaranteed and non-guaranteed sources. But I know our viewers can't see this huge elephant in the room, but 2022 was a tough year for fixed income and has really challenged the ballast mentality that people look to for fixed income. I think even some folks are even looking a little bit more at insurance or guaranteed types of solutions for at least a piece of ballast in their portfolio. What would you tell some of those folks looking at fixed income and its role as a ballast in a portfolio?
Yeah, certainly. 2022, a lot of people, I don't want to say suffer from recency bias, but it is very fresh in people's minds, right? Where you had stocks sell off in a pretty meaningful way. And I just gave the example that typically when stocks are down, you have fixed income positive. That wasn't the case in 2022. And, the reason why is we were really in this fixed income dungeon, right? When you look at where just the overall level of rates were across fixed income, the Fed was starting at the zero bound, right? So the Federal Reserve rate was 0. And what that left the fixed income universe with was a level of very low yields. So the yield on the Bloomberg Barclays US Aggregate Bond Index, which is a very widely used index in fixed income, was 1%. If you took on more credit risk, right, so you go to high yield corporate bonds, which is below investment grade rated, right, you're taking on a lot of credit risk, the yield there was a whopping 3.5%. So very difficult to generate any sort of meaningful positive returns, but more importantly, very difficult to offset any moves higher in interest rates when you're starting from such a low level. And again, kind of decomposing the word fixed income, right? 50% of that is income. There was really no income a few years ago. Fast forward today, we're out of the fixed income dungeon and we're more in a fixed income sanctuary, right? When you look at the yields or coupons across different categories of fixed income, they're in the mid-single digits, right? So this is taking into account just your cash on cash return. So if rates don't do anything, if spreads don't do anything, just what investors can expect to clip from a coupon standpoint. And for fixed income investors, right, that's very important because a lot of whether retirees or other people that invest in fixed income that rely on monthly or quarterly distributions, these levels a few years ago were much lower. Today they're back to more historical norms, or in some cases higher, right? So if you look at different parts of the market, and the core category, right, is very high quality, typically US Treasuries, agency mortgages, you're not taking on a lot of credit risk. The coupon there is annualized around 4% today. You take on a little bit more credit risk, right? You go to the intermediate core plus category, which is a very large part of 401k plans, right? The coupons there are mid-single digits. So something that wasn't around a few years ago, that now fixed income is back to playing that role of providing income, regular income, right, and reliable income for investors.
Yeah, so I think we said at the beginning, it's the framework, and it's BIGG, which helps you kind of remember all of the things you need to speak about together. So fixed income today is probably a better ballast than it's been in a really long time, especially with those higher yields acting as a cushion, some higher credit quality names available. You mentioned incomes available by referencing some of those average coupons. Maybe just an example again of some of the coupons that are coming off of some of these sectors.
Yeah, when you look at different Morningstar categories, again the core category I think is right around 4%. If you go all the way to the spectrum on emerging market debt, which is more risky, but coupons there are 6 to 7%. So depending on the risk tolerance of the investor, you can get very reliable, again, monthly or quarterly income from more traditional parts of fixed income.
Sure. So if we talk about it again, we've got fixed income as a ballast, fixed income as an income potential now too as well.
Mm-hmm.
You mentioned yields and coupons sort of together. Yields actually helps you understand a little bit about that next category, growth, right?
Certainly. So when we think about fixed income forward-looking returns, a great place to start is your starting yield. And again, rewinding the clock back a few years ago, the starting yields were very low, so your forward-looking return expectations were very low. Today, though, where we sit with the yield on the Bloomberg US Aggregate Bond Index of right around 5, a little bit north of 5%, the expected return over the next 3 years is right around that starting yield, right around 5 and 5.5%. So as fixed income investors, that's what most people are used to. But given what we've seen in the equity market over the past few years, 5.5% might not be as exciting, right? When you look at what the Nasdaq is doing or the S&P 500 is doing. But it's always important to remember that, and again, thinking back to ballast, right? You want to provide a smoother ride. So we've seen the long run average return for equities has been around 8%, but there's been a lot of volatility there, right? The annualized standard deviation is about 14%. Starting yields today, get you to around a 5.5% return, but the historical volatility or standard deviation has been about 5%, right? So we think, and oftentimes we refer to this concept as convexity, right? Your upside relative to your downside. We think that fixed income can not only provide that ballast and also provide the level of income for people that are in the wealth preservation phase, but also people that are in the wealth accumulation phase. We think fixed income can provide a strong potential growth driver. And yield is one measure. We also look at dollar prices, right? So in equities, everyone talks about you want to buy low and sell high. And that's exactly what you can do in the fixed income market today. When you take a look at a lot of dollar prices across fixed income, you can see that there's discounts of 10, 20, 30 points to par. And assuming no defaults, now certainly there could be some defaults in certain parts of the market, but we do expect most of these asset classes, right, or most of these fixed income sectors to mature near par. So there's the potential for not only strong price appreciation, right, but also the income, right, in serving as that ballast.
Right. I mentioned equities, right? Equities can play a role in the retirement income discussion, but they come with a lot more volatility. They do have a lot more growth potential, right, but they can have a weaker ballast.
Certainly.
Right? So again, it's this trade-off between the first three metrics that we talked about. And there's a lot of statistics that fixed income has readily available to help analysts like yourself analyze the variety of different products out there. So ballast, income, growth are the quantitative measures you can pick apart. Let's shift to Gates.
Mm-hmm.
Gates is this much more qualitative aspect of retirement income analysis. In the non-guaranteed side, Gates are a lot less. In the guaranteed side, even the hybrid insurance side, it does come with a lot more potentially portability problems, maybe higher fees, maybe some transaction restrictions. Maybe tell us a little bit about fixed income's role and some of the gates that might not be there.
Yeah, so you mentioned the different, gates or potential transaction issues if you were to transact in some of these guaranteed type products. When you think about mutual funds, right, fixed income mutual funds, they're daily liquid, right? You can transact every day. There's typically low or no transaction fees. And then also the underlying collateral within these funds is very liquid, right? So when you look at the fixed income universe, a large part of what makes up fixed income mutual funds is going to be US Treasuries, agency mortgages, investment grade corporate bonds, right? These are very large markets, very liquid markets. So not only do you have a product where the underlying collateral is very liquid, but you also have a product that you can transact and you don't have to worry about some of these potential gates that you would in some of these other products.
Right, you're in a high quality investment with good income that's providing a good ballast.
With growth potential and limited gates.
Any of those fixed income sectors jump out at you as having a little bit more growth opportunity without taking on too much risk?
Yeah, so what we're seeing in today's marketplace is one of the most attractive areas of potential growth and income and ballast would be in the agency mortgage sector. So these are bonds that are backed by the government, right? You're not taking on credit risk, but given where spreads are relative to corporate bonds, we believe there's a lot of relative value in agency mortgages, and that's a lot of what we've been investing in our mutual funds here at DoubleLine is the agency mortgage sector.
Yep, that's all been very, very helpful. Thanks for sharing your insights today. Thank you, everybody, for joining us for this special retirement income discussion. Thank you, and if you have any questions, please feel free to email us at retirement@doubleline.com. Thanks for joining us. Be good out there.